Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Atlassian.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really jump in, just a quick reminder that you can find a special 14-day trial link for StockOracle down in the description.
Right, and just as a quick heads up, StockOracle is an AI-aided stock research platform. That link below is an affiliate link, which just means the channel might earn a commission at no extra cost to you.
Yeah, and we always want to remind you that StockOracle is a research tool, right? It is not financial advice. It's not a trading signal service or, real-time market data.
Exactly. The AI insights and their valuation estimates, well, they can be incomplete or sometimes just wrong. So always make sure to verify important facts for yourself.
For sure. All right, so let's get into today's analysis. Imagine a software giant that basically serves as the absolute backbone of the Fortune 500. They just reported this massive 35% single-day stock surge, generated over $1 billion in free cash flow, and Wall Street analysts are just like tripping over themselves to upgrade it.
But, and this is a massive but, if you actually look under the hood, this exact same company technically has negative net income.
Right.
And on paper, they have a concerningly low amount of cash on hand to cover their short-term obligations.
It's the ultimate financial contradiction. I mean, you have this appearance of unstoppable runaway momentum, and it's colliding head-on with a balance sheet that looks like it belongs to, I don't know, a distressed asset.
Yeah, it really forces you to ask what is actually real here.
Exactly. And for those of you navigating the corporate world right now, you probably spend half your day in their ecosystem, right? You've got Jira for project management, Confluence for documentation, Trello for workflows.
Oh yeah, they are the digital infrastructure of modern business at this point.
Oh yeah, they are the digital infrastructure of modern business at this point. They really are. And our goal today is to decode this wild August 2026 performance.
Yeah.
We need to bridge this massive gap between their booming top-line revenue growth and their, frankly, kind of concerning bottom-line profitability.
Because by the time we finish, you'll have the context to figure out if their explosive stock recovery is a genuine structural turnaround or, just a momentum trap waiting to snap shut.
And the stakes are incredibly high for anyone watching the enterprise software space right now.
Oh, absolutely. Because when you isolate just the top-line growth metrics they recently released, it's remarkably easy to get swept up in the market euphoria. The raw sales velocity paints a picture of total dominance.
I definitely want to start by unpacking that euphoria because the headline numbers they delivered for their Q3 fiscal year 2026 results, they're undeniably impressive. Wall Street basically threw a parade.
I mean, revenue grew 32% year over year, hitting $1.79 billion. Yeah, that is their sharpest growth trajectory in at least 6 quarters. And they completely crushed earnings expectations, too. Adjusted earnings per share came in at $1.75, which blew past the consensus estimate of $1.34.
Right, so the total revenue is impressive, but composition of that revenue is what really caught the market's attention, didn't it?
It did. For years, Atlassian's entire corporate strategy has hinged on transitioning their customers away from legacy on-premise servers and getting them into the cloud.
A great migration.
Exactly. And this quarter, their cloud revenue finally crossed the $1.1 billion mark. So not only did it cross this major psychological milestone, but the growth rate actually accelerated to 29%.
Which is incredibly rare. Usually, as a revenue base gets that massive, the percentage growth slows down, right? Because the denominator is just so large.
Right. The law of large numbers.
Exactly. So accelerating at $1 billion run rate, that shows immense gravitational pull.
Yeah.
And looking at their remaining performance obligations, often called RPO, the gravitational pull is really locking things into orbit.
Yeah, RPO expanded 37% to a staggering $4 billion.
So just to clarify for everyone, I assume RPO functions like a guaranteed subscription pipeline.
That is the best way to think about it, yeah. Remaining performance obligations, they represent revenue from contracts that customers have already signed, but Atlassian hasn't recognized yet because the service hasn't been fully delivered.
Got it.
So a 37% expansion in RPO is a huge leading indicator. It tells us that major enterprise customers aren't just testing out Atlassian on month-to-month plans.
Right, they're logged in.
Exactly. They were signing massive multi-year binding commitments. It provides a highly predictable floor for future cash flows.
And, we really can't discuss a tech company in 2026 without looking at how they're deploying artificial intelligence. Atlassian has this new breakout AI product called Rovo.
Oh, the traction metrics on Rovo are wild. Usage is compounding at over 20% month over month.
Yeah, but the specific metric that stood out to me was the revenue impact. Customers who integrate Rovo into their workflows, they're growing their annual recurring revenue, or ARR, at twice the rate of non-users.
And that specific metric answers the biggest question surrounding enterprise AI right now, which is monetization.
Yes, because a lot of companies have flashy AI tools that don't actually generate a single dollar of new revenue.
Right. But Rovo is acting as a direct catalyst for account expansion. See, when a company uses Rovo, the AI connects fragmented data across Jira, Confluence, and third-party apps, basically creating a searchable knowledge graph for the whole business.
Which sounds incredibly sticky.
It is. Because it becomes so useful, the customer inevitably embeds themselves deeper into the Atlassian ecosystem. They add more employee seats to their license, they upgrade to premium tiers.
So it functions like a digital nervous system. Once a massive organization installs Atlassian software and then integrates this AI layer on top of it, ripping it out would essentially paralyze their operations.
The switching costs are astronomically high.
Yeah, that completely explains their 120% net revenue retention rate in the cloud and, why they maintain a footprint in 80% of the Fortune 500. They also noted their service collection, which handles IT service management, just crossed $1 billion in ARR. They claim they're actively stealing market share from legacy competitors.
Yeah, they just recorded their largest ever quarter for competitive displacements, which is huge because it proves their growth isn't just organic expansion within existing accounts.
It's predatory.
Exactly. They are actively ripping and replacing older systems from competitors. When you combine that incredible product stickiness with AI that actively accelerates customer spend, you're looking at a highly durable defensive moat.
I mean, if we pause the analysis right here, it sounds like we're describing the greatest software business on earth, right? An unbreakable moat, accelerating cloud adoption, AI that demonstrably drives sales, and $4 billion in guaranteed future contracts.
It paints a flawless picture, provided you only look at the top half of the income statement.
Right. So let's pivot to the bottom half then, because despite all this phenomenal top-line execution, the stock is still down over 30% for the year. The balance sheet presents a really gritty, uncomfortable reality.
It really does. Let's talk about this profitability paradox.
Yeah, let's get into it.
Despite pulling in $1.79 billion in a single quarter, their trailing 12-month net margin is actually negative 3.5%. On a generally accepted accounting principles basis, GAAP, they're losing money.
And the Q1 2026 data illustrates the severity of this. Their GAAP operating income plummeted to negative $48.7 million.
Right.
So they are successfully scaling their revenue faster than they have in a year and a half, but they are fundamentally failing to convert that top-line growth into bottom-line GAAP profitability.
Yeah, and I'm looking at this massive gap between the $1.57 billion in levered free cash flow they reported and that negative GAAP net income. I have to assume a massive chunk of that discrepancy is stock-based compensation, right?
Well, absolutely.
Instead of paying their engineers and executives in cash, which would drain their bank accounts, they're just issuing them new shares of stock.
You've hit on the exact mechanism bridging that gap. Stock-based compensation alongside massive amortization of acquired intangibles allows them to report robust free cash flow.
Because paying employees in stock saves cash today, making the cash flow statement look pristine.
Exactly. But the true economic cost is borne by you, the investor. If a company constantly prints new shares to pay its bills, it aggressively dilutes the existing shareholder base. Your slice of the pie continually gets smaller.
So they are essentially printing their own currency to fund operations.
Pretty much, yeah.
That makes their $1.57 billion cash pile look a lot less like operational efficiency and a lot more like financial engineering.
And my concern deepens when I look at the debt and liquidity metrics. Total debt sits at $1.24 billion. Their debt-to-equity ratio is 141.4%.
But the metric that genuinely stopped me in my tracks was the current ratio, which is sitting at 0.7x.
Yeah, that's low.
For anyone analyzing a traditional business, a current ratio below 1.0 means your short-term liabilities exceed your highly liquid assets. It implies you don't have enough cash to pay the bills coming due in the next 12 months.
Right. So how is a company dominating a $67 billion total addressable market operating on the brink of technical insolvency?
Well, A 0.7x current ratio sounds terrifying for a traditional manufacturing or retail business, but this is where we really have to understand the nuances of software as a service accounting.
Okay, explain that.
That massive liability dragging down their current ratio isn't a bank loan coming due tomorrow. The vast majority of it is deferred revenue.
Ah, okay. So deferred revenue is money they've already collected,
Yeah.
but haven't technically earned yet.
Precisely. Let's say a Fortune 500 company signs a one-year, $12 million contract with Atlassian and pays the entire amount upfront in January.
Okay.
Atlassian suddenly has $12 million in cash, but they haven't provided 12 months of software access yet. Under GAAP accounting, they have to record a massive liability on their balance sheet deferred revenue, representing the software service they owe to that customer.
That makes perfect sense. So it artificially drives the current ratio below 1.0, making them look illiquid. But that specific debt doesn't require Atlassian to write a check.
Right.
It just requires them to keep the servers running for the rest of the year.
Exactly. So they are not at risk of bankruptcy. That $1.57 billion in free cash flow provides a substantial safety net.
Yeah, but even with that context, a ratio of 0.7x combined with a highly leveraged balance sheet means their financial flexibility is severely constrained, right?
Oh, definitely. They are running incredibly lean. And the true danger arises when you look at how the market is valuing this company. The stock currently trades at an extreme 129 times enterprise value to EBITDA.
Let's translate that multiple because it's wild. Trading at 129 times EV to EBITDA means the market is valuing the entire enterprise at 129 years worth of its current cash earnings.
That valuation leaves absolutely zero margin for error.
None at all. It is priced for absolute perfection.
The market is underwriting a massive future margin inflection. Investors are paying a premium today under the assumption that Atlassian will eventually, flip a switch, scale back the stock-based compensation, and become wildly profitable on a GAAP basis.
But that inflection hasn't arrived yet.
No, it hasn't, and this creates a brutal tug-of-war for anyone analyzing the stock. The bull case is anchored by unstoppable top-line growth, incredibly sticky cloud transitions, and AI dominance.
While the bear case focuses on a leveraged balance sheet, zero GAAP profits, and a valuation price for perfection.
Right. And that tug-of-war is directly responsible for the whiplash we're seeing on Wall Street. The price action has been violently volatile.
I mean, just a few months ago, in April 2026, the stock cratered to a 52-week low of $56.01.
The sentiment was abysmal.
It was. Then they released an earnings report, and the stock surged 30%. A few months later, on August 7th and 8th, following another earnings release, the stock popped another 35.3% in a single day, closing at $149.07.
And that August surge was heavily fueled by institutional analysts rushing to revise their financial models and upgrade the stock. But the divide among those analysts is fascinating.
Yeah, you have Wells Fargo, KeyBank, and Oppenheimer all publishing notes on the exact same day, raising their price targets to the $180 to $200 range. They're looking at that 29% cloud growth and screaming buy.
But then Cantor Fitzgerald looked at the exact same earnings data and slashed their target to $98.
Cantor Fitzgerald is focused on a very specific warning sign, hidden in the revenue breakdown, aren't they? The pull-forward risk.
Yes. Let's break down this pull-forward risk, because Atlassian proudly reported that their older legacy data center revenue surged by 44% year over year.
Right, and on paper, a legacy product growing that fast sounds like a massive win. So why is Cantor Fitzgerald using that 44% surge as a justification to slash their price target?
To understand this, we have to look at the mechanics of enterprise IT migrations. Atlassian is aggressively forcing its customer base to migrate to the cloud by systematically ending support for their old server products.
Oh, okay.
So imagine you are the chief information officer of a massive global bank. You are facing a forced migration to the Atlassian cloud that is going to take your team 3 years to safely execute. What do you do today to ensure your systems don't go offline in the meantime?
Well, you panic buy a multi-year license of the old data center software just to buy your team enough time to execute the migration safely.
Exactly. It's like Microsoft announcing they are permanently deleting Microsoft Word next year, so every enterprise panics and buys a 5-year offline license today.
Wow.
It makes Microsoft's revenue look absolutely incredible this quarter, but it totally cannibalizes their sales for the next 5 years.
That is the exact dynamic playing out here.
Mm.
Atlassian's management even admitted on their earnings call that a significant portion of this 44% surge in data center revenue was early purchasing from large enterprises preparing for the migration deadline.
And Cantor Fitzgerald is warning that this creates a massive air pocket for fiscal year 2027.
Right, because once that pull-forward demand fades and those legacy customers are locked into long-term contracts they've already paid for, Atlassian's overall revenue growth could sharply decelerate.
Knowing that revenue air pocket is looming, I look at the technical chart and I have to wonder, is a 35% single-day pop a dead cat bounce, like a temporary relief rally in a stock that's fundamentally breaking down? Or is this the start of a structural recovery?
The technicals really require you to look across different time horizons. A 35% move confirms that immediate short-term momentum has violently reversed to the upside.
Okay.
However, if you zoom out to a wider lens, the stock is still technically in a recovering downtrend. Even sitting at $149, it is down roughly 40% from its 52-week high of $189 just a year prior.
So it's climbing out of a very deep crater, but it hasn't reached the surface yet.
Exactly. Furthermore, technical charts don't exist in a vacuum. We have to consider the broader risk of multiple compression in the software sector.
Right. Historically, during periods of economic tightening, the market just stops paying 100-plus multiples for unprofitable tech companies.
Yeah, even if Atlassian executes its cloud transition flawlessly and hits every single revenue target, their stock price could still fall simply because the market's willingness to pay a 129 of EBITDA premium evaporates.
And that threat of multiple compression forces us to zoom out and look at the macroeconomic environment, because extreme valuations rely heavily on the broader global economy, keeping capital cheap.
But surprisingly, the macroeconomic wind just shifted heavily in Atlassian's favor.
It did. The July 2026 jobs report was weaker than expected. The economy contracted by 23,000 jobs, and the unemployment rate ticked up to 4.1%.
And in the bizarre counterintuitive logic of Wall Street, bad economic news is actually a massive tailwind for high-growth tech stocks.
Wait, why is that?
Well, a weakening labor market means the Federal Reserve is far less likely to hike interest rates, and they might even cut them. High-valuation growth stocks are essentially valued based on their future cash flows.
Okay, yeah.
When interest rates fall, the present value of those future cash flows increases in financial models. So a weak economy lowers rate expectations, which artificially props up those massive tech multiples. The macro environment is basically providing a perfect tailwind for Atlassian.
Okay, let's tally this up. Wall Street analysts from major banks are upgrading the stock to $200. The macroeconomic winds are perfectly at their back. The stock just jumped 35% in a single day. You would assume the executives running the company are popping champagne and buying up as much of their own stock as they possibly can, right?
You would assume that, yeah. But the insider flow data tells a completely different and, honestly, deeply concerning story.
To me, this is the ultimate red flag in today's analysis.
Totally.
Over the last 90 days, while this massive stock recovery was taking place, company insiders executed 41 separate sales of their own stock. Do you know how many purchases they made on the open market?
How many?
0. They offloaded a net 27,861 shares right as the stock was surging.
Wow. The psychological disconnect here is vital to analyze. In financial markets, the old adage is that corporate insiders might sell their stock for a dozen different reasons, right? They're buying a house, paying taxes, or simply diversifying their wealth. But insiders only buy stock on the open market for one reason. They believe the price is going up.
And the hypocrisy is staggering here. Wall Street is screaming buy, the macro environment is giving them a boost, they are touting this highly monetizable new AI tool, but the executives who actually review the internal spreadsheets every single day are quietly heading for the exits.
It is a potent warning sign. When a company is supposedly in the early innings of a massive structural turnaround, you want to see the management team aggressively buying the dip.
You want them eating their own cooking.
Exactly. A pattern of consistent insider selling with absolute zero offsetting purchases strongly implies that the management team views this 35% rally not as the start of a run to new all-time highs, but as a liquidity event. It's a convenient opportunity to get out at a favorable price.
So we have all the pieces of the puzzle on the table. The top-line triumphs, the profitability paradox, the looming revenue air pocket, and the glaring insider sales. What does this all mean for you, the listener, who is trying to figure out the long-term view and if the stock is a trap or an opportunity? Let's synthesize the data for a final verdict.
Based on the totality of the financials and the market data, the overall assessment lands at a bullish score of 6 out of 10, a strictly neutral stance.
A 6 out of 10. So it is certainly not a disaster, but it is far from the screaming buy that the 35% single-day surge might imply.
You just have to weigh the competing forces. On the positive side of the ledger, Atlassian boasts an incredibly durable competitive position. They have a $4 billion contractual backlog, highly sticky enterprise customers who cannot easily leave, and they consistently generate massive amounts of free cash flow.
But on the negative side, they're fundamentally failing to convert their revenue into bottom-line GAAP profitability. They heavily dilute shareholders with stock-based compensation, their balance sheet is highly leveraged, and corporate insiders are selling.
Right. So if you are following this story, what is the specific catalyst you should be watching for? What specific metrics would turn this neutral 6 into an 8 or a 9?
The ultimate test will be the upcoming Q4 fiscal year 2026 earnings report. Do not just look at the headline revenue numbers.
What should they look for?
A genuine upgrade in the fundamental view of this company requires two specific things happening simultaneously. First, they must prove that the pull-forward demand didn't completely cannibalize their future by sustaining cloud revenue growth above 25%.
Yeah. And the second?
Second, and most crucially, we need to see 2 consecutive quarters of positive GAAP net income.
Meaning they finally prove to the market that their core business model can actually operate profitably without hiding their operational costs behind stock-based compensation.
Precisely. Until that GAAP margin inflection arrives, paying 129 times enterprise value to EBITDA makes this a highly speculative place to park your capital, regardless of the recent momentum.
That paints an incredibly clear picture of the stakes. As we wrap up today's talk, I want to leave you with a lingering thought to ponder. For the last several years, whenever financial analysts have challenged Atlassian on their lack of bottom-line profitability, the executive team's defense has remained identical. We are in the middle of a massive cloud transition. Transitions require heavy upfront investment. Once the transition is done, we will be highly profitable.
It's the classic jam tomorrow, never jam today strategy.
Exactly. But look at where we are now. That massive cloud transition is finally nearing its completion. Yet instead of harvesting the profits from that effort, Atlassian is immediately pivoting and plowing massive amounts of capital into a brand new AI transition with Rovo.
So the question you have to ask yourself is are these perpetual transition and reinvestment phases truly just the unavoidable cost of staying relevant in the fast-moving tech sector?
Or are they highly convenient, constantly shifting cover stories designed to distract us from a business model that simply cannot operate profitably at scale?
It is a multi-billion-dollar question. And how Atlassian answers it over the next 2 quarters will dictate whether their momentum carries them forward or finally runs out of gas.
Beautifully said. Thanks for joining us today. Keep questioning the headlines, look under the hood of the balance sheet, and be sure to subscribe, like, and comment if you enjoyed the breakdown. And don't forget to grab that special 14-day trial link for StockOracle in the description below to do your own AI-aided research. We'll see you next time.